Oh, hey, I didn't see you there. I've been learning to make my own iPhone. Nah. But the US and China, the world's two largest economies, have basically stopped trading with one another. And people are worried. They're wondering how bad could this get for the global economy and the stock markets. So we're going to talk about that today. I'll also talk about some moves I've been making in my own portfolio and how I think about investing during bear markets. So let's dive right in. Well, unless you've been living under a rock, you know one of the biggest pieces of financial news this year is the unveiling of the Trump tariffs on April 2nd, aka Liberation Day. Those tariffs were much more broad-based and severe than the market had been expecting. In fact, there were tariffs levied on countries that don't even have human populations living in them. So the immediate reaction was for markets to sell off, both in the US, but also in Europe and Asia as well. And we actually flirted with the worst three-day period in market history here in the US before rallying massively on Wednesday, April 9th, when the Trump administration decided they were going to pause those tariffs for 90 days on all countries except for China. But nonetheless, we're still seeing reverberations from these tariffs, both in markets and the global economy. We've seen 10-year and 30-year U.S. government bonds selling off recently, and that's creating a rise in those treasury yields on the long end of the curve. That could have implications for government financing as well as for the borrowing cost for consumers and businesses. We've also seen a massive sell-off in crude prices, suggesting that commodities investors are worried about crude demand in a potential recession. And we've also seen a huge downward move in the US dollar versus other currencies like the yen and the euro. So the DXY, the value of the dollar against a basket of those currencies, is down almost 10% year to date, which is a huge move down for the dollar. And that's creating a double whammy for foreign investors who are invested in US assets, because not only are they losing on the overall nominal returns, but when they go to exchange back to their home currency, they're also experiencing another loss on top of that because of the depreciation of the dollar. So that's causing outflows out of some US assets. And remember, foreign investors own about a third of all US treasuries. So if they start to stampede out of government bonds, that could create a real crisis. Now, it's not all bad news out there. There are some assets that are still performing well in this environment, although there's only a few of them. But gold is one of those, and it's up about 25% year to date, up over 45% in the last year. We've also seen some relative strength out of Bitcoin lately. It's up about 8 or 9% just in the past month. And it's down slightly, about 5% for the year, but it is outperforming US stocks and other global stock indices on a relative basis. Now, will U.S. stocks really see these massive outflows on an ongoing basis if the Trump tariffs actually get resolved, if there's trade deals? We don't fully know, but we have seen evidence that foreign investors have been exiting some of their or reducing some of their stock exposure. And when we look at non-financial data, there does seem to be a sentiment shift here among foreigners as it relates to the U.S. We've seen a decline in international travel to the U.S. from a number of different countries, as you can see here in this chart. And we're also seeing domestically that even domestically, U.S. consumers are pretty downtrodden. I mean, they're feeling pretty gloomy. You can see here, these are some of the worst consumer sentiment readings that we've seen in many years, even worse in some cases than the bottom of the COVID timeframe. As we look at polls for how consumers feel about the Trump tariffs, they do tend to skew based on political leanings. But overall, it does look like a majority of Americans do not support these tariffs, or at least the way that these tariffs have been implemented. When we look at some of the harder pieces of data, Q1 GDP forecasts from the Atlanta Fed, I called these out on the last video as having some weird things that are happening underneath the surface. So because of tariffs, we've had a ton of companies trying to import goods ahead of the tariffs going into effect. And you can see the huge net import increase is actually causing about a negative 4% downward impact on GDP for the first quarter. So we might have slight GDP growth if not for that massive increase in net imports, but still, we still have GDP weakening regardless, even if we didn't have the negative impact from imports. And it'll be interesting to see what this means for the forward GDP numbers as these import numbers tend to reverse here in the second and third quarter. But it is clear that growth does appear to be slowing. We're also seeing a increase in the odds of recession being priced into prediction markets like Polymarket and Kalshi and others. In fact, Polymarket's currently sitting at around a 56% chance of a U.S. recession in 2025, and it had been as high as 65% at one point a couple of weeks ago. Now, as we look at spending data from the consumer, it's not as evident that things are falling off a cliff yet. In fact, in Q1, Bank of America reported that across all of their customers, they saw a 4% increase year over year in consumer spending in Q1. And when we look at March retail sales from the official retail sales report in the US, retail sales were up over 4%. We're also tracking weekly retail sales in some of these measures like the Redbook Index, and those were up as much as 7% in the early parts of April. Now, what could be causing this is what we might call bullwhip or pull forward effects. And we saw that during COVID when consumers were buying things like gym equipment, for instance, or buying things that were starting to go into shortage. And that could be what's happening here as well. Consumers may be buying automobiles and electronics ahead of potential price increases from tariffs. And the JP Morgan CFO on their Q1 earnings call called that out, that they think they're seeing some of that pre-buying activity by consumers. So it's going to be really important for us to monitor consumer spending as we get into the later parts of Q2 to see if this really starts to fall off a cliff. So as it relates to China, now, even if the US were to get deals done with all these other countries, one thing that's very concerning is the US and China are the two largest economies in the world. They had $600 billion of annual trade last year, and that trade is headed very quickly to zero in this current environment with the current massive tariffs. We've also seen announcements here, these headlines like NVIDIA taking a $5.5 billion charge because they can no longer sell H20 chips into China. We've seen Tesla have to suspend production on some of its models because of a shortage of parts that they were sourcing from China. We've seen retailers saying they're stopping shipments. We've seen parcel services saying they're not going to send shipments through, both on the US side and on the Chinese side. So this is a very, very significant development. Another way to see this, we've seen big Chinese retailers like Temu and Shein go from spending millions of dollars a day on ad platforms like Facebook and Instagram and Google and Snapchat and X, and that has essentially gone to zero almost overnight. It's going to be really interesting to see what Google and Meta have to say here in the next week on their earnings reports about what they're seeing in terms of that impact on advertising spend and how significant that will be. Amazon's another large company that could have big impacts there as well. So it's not just that these Chinese retailers are going to be hurt, by the way. There are a lot of U.S. manufacturers that import a lot of the parts of their supply chain from overseas and from countries like China. In fact, this chart from Apollo shows that 37% of U.S. imports from China are actually for intermediate goods used by U.S. manufacturers themselves. And we can see this as well when we look at some of the regional manufacturing surveys. Conditions are falling off a cliff, new orders are falling off a cliff. And basically, it looks like U.S. manufacturers are seeing a massive fall off in activity. And so if the goal for these tariffs was to actually bring manufacturing back and strengthen U.S. manufacturing, it's certainly not working in the short term because it's really upsetting the supply chains of the existing manufacturers. And so this is creating essentially a manufacturing recession in real time. And whether this can be reversed quickly enough is an open question. It also is going to impact major retailers, including retailers like Target and Walmart and Costco and other clothing retailers. A lot of those retailers have a ton of products on their shelves from overseas and from China. And by losing those products, not only do they lose potential sales, but they could also see hits to their margins if they decide not to increase prices on consumers. And so these estimates from Morgan Stanley show that some retailers are very significantly exposed in terms of their potential profit declines from these current tariffs. Now, what is the end game here? Because this is leading to declines in approval ratings for the Trump administration, pretty significant and fast declines here, including in states that Trump won that were battleground states. And so as we think about, going forward, 2026, there are big midterm elections for the Republicans. And I don't think the Trump administration and Republicans are going to want to be in the middle of a terrible economy and an economy that's in deep recession. So I think we will see more backpedaling by the Trump administration at some point and some resolution, hopefully, for the U.S.-China situation. But the question is, when does that come? Does it come in late summer or fall, or can it come in a matter of weeks? And that's very key. Now, I do like to think about what is the bull case here, because a lot of investors have very bearish sentiment, and positioning among institutional investors has gotten significantly bearish. And so what could go right? It's important to think about that as an investor as well. Obviously, trade deals that can be struck, and we've seen rumors that the U.S. may strike a trade deal with Japan soon, or Vietnam and other countries like that it's on a little bit more friendly terms with. And then eventually, hopefully, a U.S.-China trade deal would provide positive headlines and hopefully some restoration of supply chains. But again, the timing is going to matter on that a lot. But also, the U.S. administration is talking about tax cuts and the extension of existing tax cuts, and that could help consumers and it could help cushion the blow from a spending perspective as well. Now, there is a question on the table here, which is, if we go into recession and tax receipts are down and the U.S. government is already running a huge deficit, then how can they make room in the budget for tax cuts? So that's something we have to think about as well. Tax cuts may become less likely if we are going into recession. So again, this means that this needs to get resolved sooner rather than later. But tax cuts could be a potential leg of the stool in a bull case here later on this year. Things like rate cuts as well. Now, rate cuts is an interesting topic because Fed Chairman Powell was out there last week saying that he's in no hurry to cut rates. And of course, this is creating a fight between him and Trump. Trump is trying to lay the blame on Powell for the current economic situation. And he's basically saying that he'd like to fire Powell if he can. And there's some questions as to whether he can do that or not. And we'll have to see how that battle plays out. But the Fed is trying to go slowly here with rate cuts, even though they probably have room for rate cuts based on the current rates of inflation and the CPI. But they want to go slow because they're concerned about the potential for price increases on a lot of goods here coming out of the tariff situation here over the next few months. And so they're worried that if they cut rates and then all of a sudden prices start increasing on a bunch of goods, that they could see a runaway wave of inflation again. So I can kind of understand why the Fed is slow to cut rates. But the market is still pricing in that there will be a couple rate cuts still by the end of the year. And I think we will ultimately get some of those. And so that could be part of a potential bull case. Now, I'm not sure rate cuts can save the economy from a trade war-induced recession fully, but it could help on the margin and it could help, certain areas of financing markets. There's also potential bull cases here with lighter regulation of certain industries. Biotech recently has been turning up because of the potential there to streamline drug approvals. We've also got the potential for there to be peace deals among the Russia and Ukraine war situation. And also we've got lower energy prices now, which should help also in consumer spending and consumer pocketbooks. By the way, we also have a global AI and AI infrastructure boom still happening amongst all of this that's happening in the economy. And so that's something else I think that's being lost in, the current market turmoil. Let's dive a little deeper here into current stock market action. So the U.S. stock market has gone from being one of the best performing markets over the past 2 years to one of the worst year to date. Most U.S. stocks are below their key moving averages. And really the only stocks that have been outperforming lately are in defensive sectors like utilities and staples. And some of the worst performing sectors have been some of the most popular: technology, consumer discretionary. We are moving into the heart of Q1 earnings reporting season. So this week we get to hear from companies like Tesla and Google, Intel and Boeing. Last week, we had a few companies like Netflix, TSMC, and some of the big banks. And I would say Q1 numbers have been pretty good so far for a lot of these companies, but investors are much more focused on forward guidance, what's happening in April, how companies are planning for supply chain disruptions, what they think the economy will look like later this year. And so that's really the key focus. It's like Q1's in the rear view, and we're really focused on guidance and what companies are seeing in real time as it relates to consumer spending and business investment and overall confidence in the economy. A perfect example of this, by the way, United Airlines last week when they reported Q1 had pretty good numbers, but they said, look, we don't know what the rest of the year is going to look like. If things stabilize and the trade war has some resolution, then we might earn $11 to $13 a share of earnings here. But if we go into a more recessionary environment, our earnings might be almost half that at $7 to $9 a share. And that's a very big difference, obviously. Airlines have a lot of operational leverage, but it also shows you just how uncertain things are out there for a lot of companies. And so that really is the word of the year: uncertainty. And some measures of uncertainty out there, like the Economic Policy Uncertainty Index, we're seeing more uncertainty levels than we saw during the peak of COVID. So really things like GDP forecasts are kind of useless right now. But I do think looking at scenarios for different earnings levels for the indices and what multiples might be applied is more interesting. So here, for example, from Goldman, we have a matrix showing what the level of the S&P 500 might look like under different earnings scenarios with different forward price to earnings multiples applied to those earnings. And Goldman came into the year, and most analysts came into the year thinking that the S&P 500 in aggregate would have about $250 to $260 per share of earnings. But now they're saying in a recession scenario that could fall to about 220, which would be down low double digits versus last year. And if we assume some multiple compression, and typically in recessions we do see multiples compress, we got as low as single digit multiples at the bottom of the GFC and around 14 to 15 times earnings multiples in both the fall of 2018 correction and at the bottom of the COVID correction. So if we got to say a 16 or 18 times multiple on the S&P, and we did have a recessionary impact on earnings, we could see an S&P 500 index below 4,000, which is still another 20 to 25% downside from where we are today. So that is a possibility that investors should be prepared for. Now, we should also think about how should we prepare or manage our portfolios in this market if we are in a bear market, because I think approaching it can be a little bit different than a bull market. In bull markets, we have individual companies that can outperform based on product announcements and market share gains and earnings surprises and things like that. In a bear market, stocks tend to mostly go down together. They tend to be highly correlated. There's lots of volatility. There's big moves in both directions. In fact, sometimes in bear markets, we see not only huge down days, but huge up days. We saw that just recently with that big move on Wednesday, April 9th, when we had that huge 10% pop in the indices. It's interesting when you look at some of the biggest down days, they cluster with some of the biggest up days. So that's what we'll see in bear markets is these counter trend rallies that can really rip the faces off investors that get too bearish and try to buy puts and make money from the downtrend. A lot of times they just get chopped up because there are these big counter trend rallies. So you have to be aware of that, and that can happen. Now, I think this also offers a ton of opportunity for stock pickers and fundamental investors because it means that there's going to be a lot of babies thrown out with the bathwater, so to speak, where companies are getting sold off to cheap levels along with the rest of their sector or along with the rest of the market, even though they may not deserve to be. A lot of companies will be gaining market share and creating new product and new growth engines during bear markets. And so if we can find those become the positions in the portfolio that then set us up to really outperform and have huge gains coming out of bear markets. So I actually love bear markets for the set of opportunities that they provide. Now, when we look at correlations, again, this is really important to understand as well. Bull market correlations, you have a lot of companies that kind of behave independently. Bear markets, we do expect a lot of companies to essentially see their share prices go down in tandem with the overall market. That's to be expected. But again, that's where this opportunity really comes from in bear markets. Now, one thing you got to be careful with is if you're going to get super, super bearish and say, I'm going to be in cash and avoid this bear market. Well, in the last 20 or 30 years, bear markets and recessions have gotten priced in so much faster than they used to. A perfect example of that is, the 2020 COVID sell-off was over in about a month. Now, granted, we got a lot of fiscal stimulus during that time frame, but we could go back to other examples as well, like the fall of 2018 or other market corrections where we essentially got back up over those levels very, very quickly. And so you have to be careful not to get too bearish, try to put yourself out of the market for a few years, and you could end up missing the upswing. And so that can be very, very detrimental to your overall returns, especially if you're a longer term investor. So important to look at the data and see that things get priced in very, very quickly. All right, so what have I been doing in my own portfolio? My 100K portfolio I've been sharing here on YouTube. This was funded back in October of last year, and the portfolio is up between 3 and 4% currently, with the S&P down about 10% in that time frame. So a really nice outperformance so far, and a lot of that comes from positions I've already realized profits on, like the Alibaba calls, but also some of the existing holdings as well. And I have been adding to positions, and I have added some new positions since we last talked. So let's talk about that. As you can see, some of these positions have become much larger core positions. And on the last video, someone asked, why own Wayfair? Why did you increase your position? And I've continued to increase it here. It's now my second largest position. So let's talk about this one because it is interesting. If you were just going by the chart, you would say, this looks awful. This company went parabolic during COVID, sold all the way off, and has sold off again recently and is now basically at multi-year lows. So my average cost is currently around where the current price per share is because I've been DCAing in this most recent correction. But what do I see in Wayfair? I see a online furniture retailer that's been gaining share, and I see a retailer that's had a lot of underappreciated progress in the business despite the weak share price. So what happened at Wayfair during COVID is it went from $9 billion to $14 billion a year of annual revenues as people were buying stuff for their home. And then, of course, revenues tapered off after COVID. And when the housing market weakened with higher interest rates, we saw things taper off. And lately, we've seen revenues basically flatline at Wayfair. They did grow slightly on a year-over-year basis in Q4. But while Wayfair was profitable during that peak COVID timeframe, they went unprofitable after 2022. But recently, in the past few quarters, they've returned to profitability. They've really focused on cutting overhead costs and increasing margins. And so that's something I think the market is really missing. And I do think at some point, Wayfair will grow again. The housing market and furnishings market will grow again in the US. And so we will see a return to revenue growth. And at the same time, you're going to see bottom line profitability really start to moon for companies like Wayfair that have really focused on efficiency, cutting overhead and increasing margins. And so I think while Wayfair has returned to positive cash flows and positive adjusted EBITDA already, I think we could see that really start to increase, and we'll really see that operating leverage once revenues in the industry start growing again. So I created some valuation scenarios for Wayfair, and we could use things like revenue multiples, although I think cash flow multiples or EBITDA multiples are probably better. Obviously, Wayfair right now does about $12 billion of revenue. I'm assuming they can probably get some growth in the years ahead. And then also, once they get that growth, I think we'll really start to see some margin expansion. Wayfair themselves have a goal of 10% EBITDA margins. So even if we assume they get to around 14 or 15 billion of annual revenue in a few years, and we assume they get maybe a little bit of the way there to their EBITDA margin targets, we could definitely see that there's a possibility for Wayfair to be generating 800 to maybe even $1 billion of EBITDA, which is basically double where they are today. And if they get there and you apply a reasonable EBITDA multiple that they've traded at in the past, then you can see that the stock could easily be a 2 or 3x type of return potential. So this is why I own the stock, because I'm thinking more long-term here. And I think this is an opportunity to own a retailer that's one of the best in its category that can gain share and can see a return to growth, particularly when it comes to profits. And so that's one big piece of the story. And even recently, Wayfair has continued to try to cut costs. They exited the German market where they were losing money for a number of years. They've been cutting some of the headcount that they deem to be unnecessary and things like that. And so Wayfair continues to do things behind the scenes that I think are the right steps to make during this tough period for the company. Now let's talk about some other new additions to the portfolio recently. I did add some Bitcoin exposure via the IBIT ETF recently in the most recent big correction. And that is about a 3.5% position now. I like it because of the supply demand dynamics, the scarce digital gold asset that you're getting that will hopefully be less correlated to the other stocks in the portfolio is nice. And so that's been a pretty nice hedge actually recently in the portfolio. And I'll continue to hold that long term. That's my goal there with the IBIT ETF. I also added Micron in the semiconductor sector. We're still in the midst of an AI boom. And interestingly, Micron provides the high bandwidth memory for a lot of the new AI server clusters and server GPUs from NVIDIA. These are becoming increasingly memory intensive, and we have seen an increase in memory prices recently. Now, despite that, and despite the fact that we've seen an increase in analyst EPS estimates for Micron, the stock is down massively in the last few months. And so because the semiconductor sector and the tech sector has taken such a hard hit, Micron has been hit as well, even though I think they're setting up actually for really, really nice earnings growth here in the next few years. And the stock is trading at a single-digit multiple of earnings. So I see it as a really cheap way to play the continued AI boom, and particularly in an area of the AI boom that we're still now just seeing an inflection point. I also added Oscar Health, a healthcare insurer, to the portfolio, a nice defensive sector with healthcare. This is another company where there's a lot of profitability progress that the market's not giving credit for. Stock is trading back down at near a multi-year low, and they've been growing revenues at a rapid rate over the last few years. They've been adding significant new clients in the individual and small business space in healthcare, and I think they can continue to grow north of 20 to 30% a year here for the foreseeable future, while at the same time they're improving margins. They've gotten to profitability after losing money a couple of years ago. They're now profitable, generating a couple $100 million of EBITDA last year, and going forward, those numbers should continue to rise significantly. So this is a company that I think can be a multi-bagger as well. Happy to talk more about that in future videos. I added Lear before the Liberation Day. I didn't expect tariffs to be that bad. Might have been a mistake, but this is a company that I followed for a long time that I think is pretty interesting because they're so shareholder friendly. They bought back 40% of their outstanding shares in the last decade. So they are a share repurchaser like no other. They're the second largest manufacturer of seats for automobiles globally. And I do think because they're so shareholder friendly, that once we get through the most volatile period that we've seen in a long time for the auto industry, if things get resolved on the trade war front, this is a stock that could have a lot of upside. I'm not adding to the position right now. It's still very small, around 2% position, because I do think there's significant trade war and cyclical risk in the near term. But this is one that I potentially could see myself owning more of in a future environment if it got better. But maybe a little bit of a mistake in terms of the timing there ahead of Liberation Day. But I am going to hold this one and kind of continue to reevaluate it. I did exit some positions. I exited all of my China exposure. So I exited Up Fintech, aka Tiger, exited the Chow ETF. And the reason for that, I'm concerned. I'm concerned about the potential for there to be delisting of Chinese stocks and Chinese ADRs from the US market as part of this trade war. It could happen from the US. It could happen from the China side if there's a rug pull. Secretary Bessent, Treasury Secretary, has said that they're not ruling out delisting Chinese stocks, even though that would probably hurt US investors a lot more than it would hurt the Chinese. That's a possibility that's on the table. And I did not want to have that potential, overnight zero risk in the portfolio. And so I will reevaluate adding China exposure back to the portfolio at some point. I think a lot of these Chinese stocks are interesting. I mean, Tiger grew revenues at over 70% in their most recent quarter. This is a company that's doing fundamentally well. Valuations are reasonable. There's a lot of interesting advances happening in Chinese tech, but I just couldn't justify the exposure with Tiger and with other Chinese stocks at the current time. I also exited my Devon energy because I wanted to reduce my energy exposure in the portfolio. I do think energy companies are facing a tough near-term environment, potentially, looking at analyst downgrades and analyst earnings revisions lower, even though I think Devon is one of the better operated E&Ps in the US and in North America, and the stock looks cheap. It's probably not as cheap as it looks in the next year or two based on where earnings are headed. So I'll reevaluate this one, and I may have overreacted a little bit, but I do still have energy exposure with Equinor, which is a double-digit dividend yielder. So I did want to just reduce my cyclical exposure here and have more cash in the portfolio for future opportunities. I also exited positions quickly that I had owned for a brief time during some of these corrections, like Airbnb, Amazon, and Deckers. I had accumulated those on some of the down days, and I realized, I didn't really want to own them. I was thinking that, these prices are getting cheap, but then when I really started to do the work on where earnings levels could go for, say, Airbnb, I did think that the stock could be lower if we're in a more recessionary environment. Even though I would like to own the company longer term, I think they are facing some cyclical headwinds here that could push the stock to lower prices that I might get a better opportunity on for accumulation. And same thing with Amazon, the supply chain disruptions, the disruption to their advertising from Chinese manufacturers, that's going to have an impact. And so I think, even though I really like the long-term opportunities, the stock maybe isn't quite as cheap as it looks on, trailing earnings numbers and things like that. So Deckers was another interesting one. It had been so oversold that I thought I need to take a position in this, and I did flip it for a slight profit, but I did think about it more deeply, and I said, I don't really know what is happening in the core UGG brand. I know that the Hoka brand is gaining market share, but the UGG brand is slowing down already, and we could see a big hit to consumer spending, and that could further push down earnings estimates. And, I just wasn't really as deeply involved from the research side as I should have been in accumulating a new position. So I exited Deckers as well. But this brings up the question of overtrading. I think I found myself overtrading. And you don't really want to be overtrading. It's easy to do during a fast-moving market like we've had, but it can create stress. It can create regret. If you're in a taxable account, which I'm not in my 100K account, but if you are in a taxable account, then trading a lot could really generate high short-term capital gains taxes. It could interrupt compounding. If you're trading around your core positions and you get too cute, you might end up with a much smaller core position for your long-term portfolio than you intended. You may miss out on gains. And so I always say trade less, profit more. And I found myself overtrading for sure. And so that's another reason why I kind of cleaned up the portfolio a little bit on some of these smaller positions and got back to a very high cash level to kind of refocus myself. So you have to be careful not to overtrade too much during bear markets, especially because, like I said, you have these counter trend rallies that can really whipsaw things around and change sentiment on a day-to-day basis and create situations where, you're not really making good long-term decisions. So question of the week comes from Tempo, who asked on the last video about avoiding the risk of Chinese company delisting by buying some of these Chinese companies on the Hong Kong exchange, because companies like Alibaba, for instance, have dual listings. They trade on the Hong Kong exchange as well. So why not go buy them? Because brokers like Interactive Brokers, for instance, will allow you to buy those stocks on the Hong Kong exchanges. And I thought about that as a way to reduce risk with the Chinese positions. But I also realized that, look, if it comes to a worst case scenario with Chinese stocks and ADRs getting delisted in the US, are they really going to allow me to buy those stocks in Hong Kong? Are the American companies going to be allowed to do that? Are brokers going to be allowed to have US investors buy those stocks? Are the Chinese going to allow us to buy those stocks if they've been delisted from the US? And so I think there's still risk, even with the Hong Kong listings for US-based investors, where they may be sanctioned away from buying those stocks. And so that's still a risk in my mind. Now, maybe it's a slightly less risk than buying the ADRs, so I can see some merit there. But for me, I just wanted to take exposure to zero during the height of this trade war. And I think it will get resolved. And like I said, I can reevaluate these positions at the point at which there's a little bit more certainty. But let me know if you've got different viewpoints. Also, let me know what stocks you're looking at in this current market environment. Be really interested to hear what stocks you want to see me do more work on, your thoughts on the current stocks in the portfolio. Hey, everyone. So just a couple more things before we wrap up here. One, I know you want to see more frequent content here on the channel. So life kind of got in the way recently, but I promise you more is coming here on StockGeekTV, and I'm going to do my best to put out stuff more frequently. Actually, to that end, I want to play around here with a new subscription tier it gives me the incentive to do more daily and weekly content. And also, I think it'll be valuable for subscribers to get perks and be able to vote on stocks they want to see me research, or do subscriber live streams, and even have more weekly tactical stuff for investing that might not be good for the YouTube algorithm, but I think could be really useful for people who are subscribing. So check that out. And then the second thing is, if you want to go really deep into stock investing and really level up, I'm going to be running my 8-week live stock investing bootcamp, which will start here towards the end of May. We're going to be announcing the dates and pricing on that here very, very soon in the next couple of days. So if you're interested in that, if you're interested in learning things like fundamental analysis and how to research companies and how to find good stock ideas, I think you'll find it really, really valuable. So the wait list is in the description of the video. Check that out. And I'll be announcing more on that soon. But until then, I hope you all are navigating this market with ease and with confidence. And I will see you guys in the next video. Cheers.